Welcome everybody to another episode of the Cross Country Super Podcast. And as usual, I'm joined by Jemma Sanderson from Cooper Partners over in Perth. How are you, Jemma? As
Uh,
usual, it is fantastic to see you.
And it's fab to be involved here again, Darin, to have a nerdy chat with you about all things SMSF.
Oh, we love nerding it up, and we recently nerded it up in person, didn't we, at
We
the
did.
SMSF Association Technical Summit. So it was great to give you a reason to come over to Sydney to visit us in person. But before we get started on today's episode, there is a sponsor's message, which we'll get to right away. Need a current or retrospective SMSF property valuation, whether it's for annual financial statements, pension commencement, or related party transactions? SMSF property valuations offer fast, reliable, and audit-ready reports across Australia. As an accountant or SMSF trustee, do you need a valuation that satisfies the ATO rules, includes documented methodology, and ticks all audit boxes? SMSF Property Valuations delivers an easy online ordering process to finish the job quickly. And of course, with all the debate around Division 296 asset valuations, but probably in particular property valuations, will be a great area of focus for the ATO. They've already said that on numerous times. There's already been a focus on valuations in general,
Yep,
sort of
totally.
cracking down on trustee responsibilities and also what auditors should look for when they're doing their audit. So both from a professional and a trustee perspective. So engaging any sort of valued property valuation service will go a long way to help you avoid any unwanted compliance issues in that area. But we'll get on to the subject for today, and we're going to actually talk about death benefits and specifically some of the stuff that goes along with it. As you know, whenever we decide on a topic, Gemma and I go off-piste,
A lot.
but it only proves that so many issues are intermeshed with one another in the SMSF world. So I say death benefits and the taxation issues associated with death benefits, but we'll cover a lot of other stuff, and you'll see that a lot of other stuff will be intermingled within our discussion as usual. But yeah, well, before we get into the sort of tax component area of it, any discussion around death benefits usually starts with who can be a beneficiary of an SMSF when a member dies, and also obviously the difference between the definition of a cis dependent and a tax dependent. So they're always the discussions to start with, aren't they, Gemma?
They sure are. And I think that that's one of the big areas, we covered off on a previous podcast about the binding death benefit nomination. So that's absolutely where the CIS definition comes through, probably as a starting point. Who can receive the benefit direct from super that you can include in a binding death benefit nomination, or that the trustee of the fund can send it to. And then you've got that differing definition in the Tax Act. So with the super definition, it's looking at basically a spouse, a child of any age. And I think that's the distinguishing factor between the tax and CIS, primarily because most of the time money here is coming either directly out to so the taxing implications of these payments tends to be not when it goes from one spouse to the other, but when it comes out of superannuation to other beneficiaries. So if you're a child of the deceased, you can receive money directly from superannuation. And if you're a dependent or an interdependent, you also fall within that definition. Now, that just means you can receive a payment directly from super under the CIS provisions, but the that doesn't mean that you're a dependent when it comes to tax, because if you are an adult child and you're not financially dependent on your parent at the time of death, then you will be a non-death benefits dependent. So the Tax Act's got this definition of a death benefits dependent and a non-death benefits dependent. Don't shoot the messenger there. And so adult children are not included as a death benefits dependent, and therefore there's tax implications that flow out if they do receive superannuation either directly from the super fund or via the estate or the will of the deceased. Lots of tongue twisters in there.
Yeah, it definitely is. It's so easy to get confused too, isn't it? With the two with the two sets of definitions,
Mm.
and obviously having to delineate between what you can actually do within the superannuation rules and then what applies with the taxation rules as well.
Yep, that's right. And I think a lot of the time, just because you can send your money directly to a child from super doesn't necessarily mean that's the best tax outcome. So one of the big things there, so this is where we get down to, someone's in pension phase or they've got their own superannuation. Now that the preservation age in super is 60 across the board, then when people get to retirement and that preservation age and they are eligible to then access their super, then they're over 60 and that money is tax-free in their own personal name. So those taxation components are almost of no consequence to them personally, because it's not like changing them up a bit impacts their own personal tax position. However, they become unbelievably important when, again, if their spouse, if one member of a couple dies and their spouse receives the money, then again, they're pretty much of no consequence. But upon the survivor's death, whatever is left in super, those taxation components become really, really important, because that tax-free component, helpfully, is tax-free. However, that taxable component is that's where we have these tax incidences coming through. So the taxable component, if it goes directly to a beneficiary from super, it's taxed at a 15% tax rate plus Medicare. And if it goes via the will and into, say, a testamentary trust or out to the beneficiaries in that manner, and the beneficiaries are these non-death benefits dependents, then again, you've got a 15% tax rate through that avenue, but no Medicare. So a lot of people direct the money through the estate avenue, because then that can flow out into testamentary trusts for the benefit of adult children and future generations. A 15% incidence on the taxable component there, but you'll have 17% if it goes direct to beneficiaries via direct from super. And the consideration there of, well, why you'd always just go via the estate, wouldn't you? Because you save Medicare. But of course, it's not as simple as that, because it does depend on the requirement or the propensity for that estate to maybe be contested by someone. If that's going to be disputed, then you might not want it to go down that path. You might want it to go direct from super to those beneficiaries. But if you're in New South Wales, which I'm not, but you are, we've got notional estate provisions. So it's almost doesn't really matter if you try and sidestep the estate. That can all just get brought back in under the notional estate provisions. So there's a lot of little puzzle pieces to navigate through.
Yeah, it's the classic situation of what should I do? Well, it depends, doesn't
It
it?
depends, 100%.
Um,
It depends.
and it sounds like New South Wales law will sideswipe you when you try to
Yeah,
sidestep.
when you try to sidestep, that's right.
Yeah, the less uh, beneficial option, I suppose you could call it. Now, in all of that, I suppose it really does emphasize, and already I'm starting to go a little bit off piste here, but it really does emphasize, and we've spoken about this before in the past, I think, as to the importance of the management of your taxable and your non-taxable component in your superannuation fund. And often it is with a view to when the member dies rather than the actual here and now,
Yeah,
which
that's right.
probably a lot of people don't actually understand that it's more a benefit of whoever passes it on, or whoever you pass it on to when you
Mm,
die,
that's
as
right.
opposed to any sort of benefit you're receiving right here and now.
Yep, that's right. And I think that it's interesting that the Division 296 those proposed changes, which at the current point in time, we haven't even seen that legislation reintroduced, but that certainly brought some of these estate planning conversations to the forefront. And a lot of people are thinking about, okay, well, I don't want to pay Div 296 tax because I don't want to pay tax on my unrealized gains. And I'm getting older and I've got this substantial taxable component sitting in my account. Is there a way that I can manage, like have my cake and eat it too a little bit with the family wealth and that moving wealth down to the next generation? So a lot of people are considering pulling some money out of super and gifting it to their children, and that whatever they pull out, you can again be strategic depending on this. Again, it depends on the structure that they've got, strategic about which account that comes out of to
Mm.
uh, make sure you're pulling it out of the account that's got the highest taxable component. So this is the other thing. Back in the day, in 2007, when we used to have different taxation components, you used to be able to cherry pick the undeducted contribution component. You could separate that out from what was back then the pre and post July 1983 component. So goodness me, 1983. And so you could keep those, you could cherry pick those out. Now we can't do that anymore because the super interest provisions come in and the proportioning rule. So if you couldn't just say, oh, well, I'll pay my tax-free component to the adult kids and we'll pay the taxable component to the spouse or however that might look. That's not how it works. The only way you can sort of cherry pick those components and consider that is if there's multiple different accounts in the self-managed fund. And the only way that those can arise is through some good taxation component management with pension commencements. And so you almost clear out your accumulation account by starting a pension. So then you've got a zero accumulation account. You could make a contribution of a non-concessional contribution and then start another new pension straight away. And that would then segregate or quarantine those tax-free components in that pension, and so on and so forth. So a lot of people, particularly in the lead up to 30 June 2007, again, I appreciate that was many, many moons ago, but that's the background. I think some people are unaware of why people have got multiple pension accounts that have got differing taxation components. That was back when we could do it, and now you still can. But the challenge we have is that whole, you can't easily just put money back into super because of the way the contribution rules work. So again, I'm digressing a little bit here, but there certainly is a consideration there for how to manage those components. And the other thing with it all is equalising, if you can, between spouses. So uh, looking at, well, do we try and use two transfer balance caps, two Div 296 thresholds, all of those sorts of things? Is there a way for us to try and swing some money from one person to the other? And then that also has a benefit of trying to re-engineer those taxation components.
Yeah, it's an interesting point, Gemma, and often I'm not going to say that this point is lost, but potentially people don't join the dots with the old withdrawal and recontribution strategy, because
Mm.
that's how you can actually manage your taxable components within a superannuation fund. Is obviously pull a taxable component out and then put it back into the super fund as a non-concessional contribution, and of course to go the extra step, start a pension with that money too. So that's actually a really powerful strategy on all sorts of levels, and probably even more so if the Division 296 tax um, proposal comes in. But
Yes.
obviously a great thing to be able to manage your tax components in your super fund. And again, with a view to what happens when I die, then whoever I pass this on to, it's all tax-free component, which is why often the question gets asked is whether or not a withdrawal and recontribution strategy could trigger Part 4A
Mm, that's
uh,
right.
issues. But time and time again, we know that that's not going to be the case because, as I said right at the start, it's Part 4A, and correct me if I'm wrong, is really about a current benefit. So
Yep.
if you buy the Coles Myer shares and you get the discount card, that's a current day benefit. You're going to benefit right away the minute that you get those shares or you've held onto those shares for a qualifying period. But this is more around, okay, well, I've structured my super fund components, but it's not me that's going to get the benefit. The ultimate benefit will be for whoever
For the kids.
the
Yep.
death benefit recipient. Yeah.
And also with that is so like in the merchant case, there was that part 4A outside super, because the only reason that some shares were moved from the family trust into the super fund was to crystallize a 50 odd million dollar capital loss. And it was an off-market transfer. So there was no change in economic benefit across the family group. So what was your motivation of doing it? Oh yeah, to get a tax benefit. So in this situation, it has been one of those areas where a lot of people have had concerns about, is it Part 4A? Are you trying to save some tax? And one of the sort of alternatives to that as well is, at any point in time whilst you're alive, you can, if you're eligible to. So again, I'm talking here, some of our older members of SMSFs, they can decide that it's up to them. They could pull all of their money out of super, and it comes out of super into their own name, and it's a member payment, and there's no tax on the taxable component. So at any point in time, they can do that. So who's to even know that if you did a withdrawal and recontribution a few times, that that would even accomplish anything? If, Darin, in when he's 85, just pulls it all out before he dies, and then it's not like that. It's a future tax potential impost, not an absolute guaranteed thing. So that's the other reason behind that not being necessarily a consideration. The other thing with that is, so a lot of the time, again, before 2017, so I'm certainly showing my age here, there was no total super balance threshold. So you could just do a withdrawal and recontribution strategy every 3 years effectively. And so obviously the total super balance threshold has made that a bit more challenging, because you've got to be mindful of how that interacts. And then generally the withdrawal component requires you to be eligible to withdraw. So you either need to be 60 and either transition to retirement, and you can take out your 10%, or you're 60 and you've got full access to your super. So it's that whole, can I withdraw, but then am I eligible to contribute? And what have we sort of been talking about so far is, maybe someone is eligible to withdraw, but they've got quite a high balance, so they can't recontribute necessarily, but let's contribute back into the spouse's account and get that tax-free component elevated. The other thing that we also see is that if it might be the situation that you can withdraw from the higher balance, and if you double dip, so you could say take out 720,000, that drops that person below the total super balance threshold, and then they swing 360 into their spouse's super, and then they can get 360 back into their own. So it depends, but there certainly is some options and strategies available, and particularly given that the bring forward cap with no work test is now available up to age 75. So I think that has actually opened up some opportunities from that perspective.
Yeah, as usual, there are so many, again, I said at the start, there are so many intertwined
Mm.
elements when you just look at one particular strategy with self-managed super funds that you do have to make consideration about all of these other things. And of course, it depends because it depends upon your personal circumstances and, you know, one size fits all just doesn't work in
Just
this.
doesn't cut it. That's exactly right. Yeah.
Now,
The other
the
thing that, sorry to interrupt, the other
no,
thing that we're also encountering, and I'll spit it out eventually, is they're thinking they're getting older. So yes, let's pull some money out and gift it to the kids, but also even closer to the end, they're like, look, we don't want to be running a self-managed super fund anymore. Let's just pull it out. And there's a detriment to doing that, because if you're in pension phase, you're losing that exemption. The assets are coming out of super and generating income outside super in the person's own name, taxed at their marginal rate. But the saving that they're getting from for the family. So again, this is a current day sort of short-term pain for the family, but long-term gain is that's then saving this death benefits tax. So the 15% tax on these taxable components is colloquially known as death benefits tax. Other people are talking about, oh, it's an inheritance tax. It's sort of, well, not really, but it's akin to that somewhat, but it's preventable and it can be mitigated if people are aware of it. So that whole, I'm paying tax along the way on the assets if I pull it all out, but could be saving some substantial amounts for the family.
Just out of curiosity, Gemma, if people rip money out of their super and gift it to their kids, is there is there any circumstances ever that the kids actually contribute that amount into superannuation? It doesn't necessarily have to be in the same SMSF or anything like that, but they actually make a superannuation contribution via that gift, or do they just go and spend it normally?
Well, with this Div 296 change, we've been chatting to some people about doing just that. So if they've already helped out their kids with mortgage, buying houses and the like, so the kids don't have mortgages, then they don't want their kids to just spend it. They want it to be for their future and for them to invest it. And having that kickstart for the kids in building up their own super towards their own sort of $3 million threshold or transfer balance cap threshold, that is certainly what more and more people are putting in place. Take it out of mum and dad's and then swing it into the kids' super. And like you said, it's not necessarily the same fund. I have seen it where, I'm not a big fan of putting your kids in your SMSF. It's just pain in the backside when the kids all of a sudden go, nah, we want to go off on our own now with our spouses. But they might already be in the fund. So money comes out as a lump sum payment to mum or dad. They gift it to the kids and they swing it back into the fund, and then it gets invested from there. So it's it certainly is something people are looking at, because there are obviously some big numbers out there in terms of what people have got in super.
Yeah, it's also, I know we're getting off topic a little bit, but
Yeah, yeah, that's okay.
it's also an interesting strategy from the point of view that they've probably got unused concessional contributions caps as well. So
Yep.
so they can take advantage if they were to recontribute it into whichever super fund they're a member of. They can quite possibly take advantage of the full gamut of strategies, contribution strategies available out there, which probably a lot of people can't actually do.
Yep. And funded by, bank of mum and dad a little bit, that amount coming out and going back in. And that's one thing to watch out for, though, is if you swing some money into super for your child effectively through that gift, and then they go over the $500,000 total super balance threshold, then if they've got unused concessional caps, then they're not going to be able to take advantage of using those. So perhaps that's all part of that sort of a strategy. The other consideration with a withdrawal and recontribution to try and it'll it's very difficult you can't really recycle all of those taxation components unless you already had a really, really, really high tax-free component. And the reason for that is it's always proportionate. So unless you can, quarantine those accounts and get rid of any of your accounts that have got even a remote taxable component in them, you're always going to have one sort of lying around. But the consideration with that is generally it's a proportion. So you might have a couple of 100% tax-free component accounts, or accounts that have only got a small taxable component in them because there was some concessional and non-concessional contributions before a pension was commenced. So they're all sort of fine. where you've got the big account there, just pulling that out, unless you can pull out it 100% and swing it back in, you're not going to be able to manage that entirely. But unless it's a 100% taxable component, then generally you've got a proportion there. So if that comes out on death, then whatever that taxable component percentage is, that is then what's taxed at the 15%. So it's not the whole account balance necessarily that comes through. So again, other little bits and bobs in that process.
There always are bits and bobs. Now, we just spoke about some thresholds that you've got to be conscious of with these types of strategies and trying to get back on the black run now.
Yeah, back on the black run.
Yeah, back on the black run now. Total super balance we've discussed a little bit, but obviously recipients have to be aware of what the implications are for their total super balance as well. When they look at all of a sudden getting a advantage of a death benefit, don't they?
Mm. That's right. And the consideration there is, again, it depends on the structure of that death benefit and how it's being paid to the person. So if they're the surviving spouse and it's reversionary, then it automatically counts towards their total super balance. If it's not reversionary, but they're the nominated beneficiary, they can start a new pension from those benefits. And when that new pension is commenced, that's when it counts towards their total super balance and their transfer balance cap. So the transfer balance cap certainly has brought like another layer of complexity into these death benefits as well, in that you can only keep in super, if a member of a couple dies, you can only keep in super what the survivors, like subject to the survivors transfer balance cap. So for those people that have got high benefits, invariably an amount is being required to be paid out of super when mum or dad dies. It's getting paid to the survivor. So whatever the tax components of that are, if it's got taxable component in it, it's going to a dependent, and so there's no tax there. So it's really just what's left over, and it's really important to be aware of it. Again, for the parents or the survivor, the taxation components are of zero consequence to them personally, because they'll be able to receive tax-free payments out of the fund, but very consequential to the next generation in terms of how that all gets managed.
Yeah, it's important to note also, and we might have covered this off last time we spoke, to understand how a reversionary pension or even a death benefit pension works, in
Mm.
that it can't be anything else but a pension, can it, Gemma? So you can't say, "Oh, I've received a reversionary pension, fantastic. I'll just keep that going." If you're over your transfer balance cap, then say, "Oh, that's all right. I'll just chuck it into accumulation and happy
Mm.
days. We're off to the races." Can't do that, can you?
No.
Whereby, if you had an existing pension, you'd have to roll your own pension back into accumulation phase to accommodate the death benefit pension as well.
Yeah, that's right. And so it's one of those things where you might be able to keep it all in super if there's enough available transfer balance cap for the survivor. But if there isn't, so let use the example. Someone dies with $4 million in super, of which half of it is pension and half of it is accumulation. And then their spouse is around and their pension account is worth 1.8 million. And they've also got their own accumulation of, let's call it 2 million. I don't know, I'm just making up some numbers here. So if the spouse, so Homer dies and he's got the 2 million and the 2 million, and so his pension is, or his accounts are going to Marge. Now, Marge has got 1.8 million in pension phase, and she's fully used her transfer balance cap, and Homer's pension is worth 2 million, so it's a bit higher. Now, if you have a look at so Homer's got $4 million worth of benefits there. Marge can't just say, oh, well, I'll just move that $2 million accumulation into my accumulation. That's not how it works. Also, that pension of Homer's, I'll just move into my accumulation as well. So I'll just keep my pension, and then I'll just end up with that $4 million being plonked into my accumulation account. We used to be able to sort of do that a little bit, but you always had to have a new pension for the individual. And then after a period of time, there was, again, some little nuances where you could deal with it. Anyway, in this situation, Marge has fully used her transfer balance cap at 1.8 million. So when a pension is commenced for her, or it's reversionary from Homer, and it's $2 million, she's going to be over. So even if she rolls back her own 1.8, Homer's 2 million flows into her transfer balance account. She's going to have $200,000 over. So she's going to have to take that out as a lump sum payment. And that's also his accumulation account is also going to have to come out to her as a lump sum payment. So that's another thing that people are just going to have to manage is there's $2.2 million coming out of the fund. Great in terms of if there's some taxable component in there, we've just managed that for the benefit of the kids. Then that's $2.2 million outside super. So she's been able to keep 3.6 in the fund, her original pension back to accumulation, and then a new pension from Homer. But 2.2 million is out of the fund. So, this isn't a topic for this session, but how is that invested, etc., and also what assets might be transferred out to facilitate that lump sum. Is it cashing stuff up and transferring it out to her, or is it just let's do an in-specie transfer of those assets to her, and then they're sitting in her own name from that perspective? So, but a big saving there in terms of the taxation components, but being aware of does that money then get put into a discretionary trust? Because that can't go then into Homer's estate because it's been paid to Marge. It's then in Marge's name. She can't then swing that into his estate and then look at, testamentary trusts might be in there set up for the kids because the testamentary trust can only come from assets in the estate. And if that's already gone to Marge, so Marge can't then swing it back in there. So there's various bits and pieces to have a look at from that perspective. Yeah, makes it, again, all complicated.
Yeah, the Simpsons example does highlight how many of these elements you have to take into account, and it probably draws me to the fact that I should have started with this, or we should have started with this by confirming the fact that death is actually a cashing.
Restriction. Yeah.
It's a cashing event
Yep.
under the superannuation rules. So if there is any restriction, well, you have to abide by those rules, and if you can't accommodate it, like the scenario you were talking about, then it has to come out of the superannuation environment. And really, ultimately, I think that that's what the government's aim is. That when you die, it comes out of the system. Yes, there are mechanisms and levers you can pull to try and keep some of it in there. But as you said, Gemma, if there's a component in accumulation phase, then you've really got no choice. And then, of course, the compulsory cashing restrictions come in when you die or when a member dies.
Yeah, that's right. And it used to be able to, so the cashing requires to either take a lump sum or an interim and then a final lump sum, which is a bit of a rubbish rule because unfortunately in a self-managed fund, there's always leftovers. It's really, really challenging to say, okay, Gemma died today, her balance is worth X and pay it out and then not to be some other leftovers sitting in there. Anyway, we digress. So it's either of interim and final lump sum or one or more pensions. So if you can't keep the money in pension phase because you've fully used your transfer balance cap, then it does have to come out from that perspective. And this is where that investment strategy side of things starts to meld in too, because in my Homer and Marge example, Marge can keep $3.6 million in super, but she's got to pay out 2.2. Which assets are they? Is it cashing stuff up and paying out the cash? Or how does that investment strategy then get managed? Are you looking then at maybe keeping the income generating shares in there and a property comes out or vice versa? You can have partial property ownership between a super fund and an individual. It's a bit painful, but it certainly can be undertaken. And then the other thing for poor old Marge in that situation is she's all of a sudden going to be over her Div 296 threshold. So how does that all factor into the equation? So it's a lot of different areas to navigate, to be aware of. And this is also why I say some people say, look, all of that just sounds way too complicated. How about I just pull some money out, gift it to the kids, stay under my 3 million, perhaps, save some tax. And then the other thing which we alluded to earlier was, if so, say Homer and Marge, well, they both die, and the kids, they're in their 80s, and then the kids are in their 60s themselves. If their kids were to inherit all of that money, then their ability to, they've only then be able to put in like 360 each, let's say. Whereas if Homer and Marge were strategic about it, they pulled a bit out now, gifted it to their kids, the kids can get in 360 each. Then in a few years, so in the lead up to a, a time of death that you don't really know, there's some opportunities perhaps to try and swing some of that wealth out and back into super, which is probably contrary to what the government wants, because um, they are trying to limit the tax concessions of what you've got in super, but we're trying to maximize that position for that next generation. So by the time they get to retirement, they're optimizing what those thresholds are.
Well, that makes a lot of sense because wasn't it Kerry Packer who said that no Australian wants to pay more tax
Yeah,
than they
absolutely.
absolutely have to? And yeah, I would challenge anybody who would debate that that is a legitimate claim because I don't think, and again, getting off piece a little bit, talking about Div 296 and obviously the implications of that and having to calculate, well, what your different strategies are and what your options are and how tax effective they'll be compared to keeping it in superannuation. I think a lot of it boils down to the attitude of I just don't want to pay any more tax.
Yeah,
Well, I don't really care what the numbers come out as, but in principle, I find the idea of just paying more tax again too egregious to want to participate. So what can I do to actually
manage
um,
that. Yeah,
yeah, manage that threshold and come out underneath it? And we can pontificate all we like about but we can put together a strategy that will help you like this. But some people, like my mother, for example, is just so opposed to, I get taxed so much on other things that
mm,
the last thing I'm going to do is pay more tax to the government. So that's just a principle thing, really. That's not got anything to do with strategy or how the numbers fall. It's just a matter of I just find that I just find that concept just way too offensive, and I'm
yeah.
just not going to do it, basically.
And I think that was when the transfer balance cap was introduced. That there was, so obviously the Div 296 threshold of $3 million. There's a a smaller number of people impacted by that, but a lot of people were impacted by the transfer balance cap. And maybe whilst mum and dad were both alive, it was fine. But then, you know, you only then get one transfer balance cap when one of them dies. So all of a sudden, well, why would I keep money in super taxed at 15% for that amount? I'll just pull it out and save some death benefits tax, plus then invest it outside super. But super has certainly been hit a few times over the last decade with transfer balance caps saying, look, you could have, and the people out there that have got these substantial amounts in super, $100 million, you could have had that $100 million in pension phase paying no tax on the underlying assets. Now, sure, you've got to take out a minimum pension, and good luck spending that. That'd be pretty fun. And then of course that got benchmarked down from that perspective. So all of these tax concessions got benchmarked down. Now that's an extreme example, but a lot of people certainly had more than the 1.6 million there. And then particularly if one member of a couple dies, being over that, and then this overlay the $3 million, it's then starting to really eke at uh, the superannuation tax concessions there. So it is worthwhile considering. I think again highlighting this session was to talk about the taxation components on death, and we've just completely that's morphed into a wider estate planning tax consideration, and just again it's the principle and the sentiment that we're getting, but there's a lot of emotion that we're seeing in this space. So it's helping the kids out to earlier, which has the added benefit of saving some money. So from a tax perspective, because it comes out as a member payment rather than as a death payment. But then we also need to manage, okay, right, well, if you sell some assets to cash it up, to pull money out to gift to the kids, well, if you're selling an asset, there might be some CGT that needs to be considered. And even on the when members die and you've got, so death benefits tax might be payable because the money is still all in super. But if you have to transfer assets out to the estate or directly to the beneficiaries, that's going to be a capital gains tax event. And so what does that look like from the perspective of then the death benefits tax, et cetera, et cetera. So taxes left, right and centre that need to be looked at and managed. So it's again, keeps us all in a job, but it's complicated for a lot of people to get their heads around.
Yeah, how you navigate this sort of stuff or try and navigate this sort of stuff without any sort of professional help or advice. Good luck to you because, we obviously live and breathe this sector, but
Hmm.
if I was to ride off into the sunset and try and figure some of this stuff out for myself, not that I'm an advisor, but I'd struggle to do it. I've
Hmm.
got my head around a lot of the rules, but I'd still struggle to do it. And I think it's kind of ironic, isn't it? I still remember when the Turnbull government brought in the transfer balance cap, and I think Scott Morrison might have been the treasurer at the
Yeah, he
time.
was. Yep.
And he was banging on. I remember he was banging on about the fact at the SMSF Association National Conference that year how they don't want to see superannuation used as an intergenerational wealth transfer tool. And I was asking a lot of questions about, so does anybody actually approach an advisor and say, oh, I want to use it as a um, intergenerational wealth transfer tool to a person? Everybody said no. So I don't,
And
yeah,
it never could be. Back in but Costello and John Howard removed that availability back in 2007. Like they set the groundwork for that. So what that comment, that just dumbfounded me, to be perfectly honest,
oh,
because we
it,
are starting to see what happened in 2007. That is starting to come through in terms of looking at, okay, that generation, the 55-year-olds plus back then, that they are starting to die, and you can't leave your money in super to that next generation without, very limited circumstances.
I remember he kept banging on about it, which is why I was asking the question. But I think ultimately, ironically, as the rules have progressed now with Div 296, it actually is going to be that because if people rip money out and gift
Yes.
it to their children, that's actually the aim that's been achieved now.
Yeah.
Isn't that the very thing that you were
And they
saying?
swing it back into
"Oh, we
super.
shouldn't be
Yeah.
doing that." Well, actually, everything that's progressed from that point onwards has actually moved it into that direction. But now, of course, the government has a different agenda, and that is, well, let's call it out for what it is. It's just a revenue grab now.
Yep.
It's not really a how the system should work or anything like that. It is purely a revenue grab, and certainly a revenue grab for the amounts that they've included in the forward estimates, which is why they're being so stubborn about
Yeah.
not even
Giving
contemplating,
an inch. Yeah.
yeah, what alternatives there might be. But getting back onto the tax,
Yeah.
the tax of death benefits, of course, in a previous podcast, I think in the last one, we did talk about reversionary, non-reversionary, and the benefits there. But of course, reversionary or non-reversionary, if it's going to be a death benefit pension, there are going to be exempt current pension income uh,
Implications. Yeah.
implications. Yeah, exactly. So what are some of those, Gemma? And obviously, if you're going to be the recipient of a death benefit pension, either way, you will want to still obviously enjoy the benefits of ECPI, aren't you?
Yep.
But there are hurdles and there are processes you have to step through in order to ensure that you've got that.
Yeah, that's right. So if it's reversionary, then one of the biggest areas is making sure that the minimum payment is paid out during that year, because that pension doesn't cease; it just continues on. So whoever's original pension it was at the start of that relevant year, then what's their minimum, making sure that's paid out over the course of the year to get the exempt current pension income and well, that concession. So over the period of time from date of death, if it's reversionary for 12 months, you get the benefit of both accounts being in pension phase and therefore ECPI over that period. If it's not reversionary, then, and I think most people will be aware of I do not like reversionary pensions and haven't done for some time. And the transfer balance cap's one of those reasons, as is the new Div 296. Anyway, if it's not reversionary, there's no minimum payment requirement in that year. Which can be a bit of a relief for some people, because it's one of those things where they don't have to then think about it. They might have to take money out of their own pension to satisfy that minimum, but if their partner dies, then there's no minimum that needs to come out of their partner's pension or pensions. Then the consideration then is so again, it's eligible for the exempt current pension income concession until it is dealt with. So if that pension is sort of sitting there for a long period of time, that's being a bit long in the tooth. The requirement is still as soon as practicably. So the cashing restrictions or the cashing provisions in the SIS regulations say, death is a condition of release with a nil cashing restriction, but it has to be cashed, and that has to occur as soon as practicably. Now, the tax office's view on that was 6 months. And they recently updated some of their guidance online to just remove that 6-month period of time. 6 months goes by in a flash. And so that can be a real challenge with dealing with that. It does have the side implication, though, that if you don't deal with that account within 6 months, so of the deceased, then making sure that the trusteeship of the fund is addressed properly, because within the 17A of the SIS Act, there's a requirement that if someone has died, you've got 6 months to make sure that either they don't have a benefit any further in the fund, or their legal personal representative is sort of wearing the hat on their behalf as a trustee or director of the corporate trustee, and you've got 6 months to do that. Otherwise, it ceases to be an SMSF, or it no longer satisfies that definition. So again, differing areas to sort of navigate when someone dies from that perspective. We do see quite a few people come a cropper on that. It's like the last thing from their mind is thinking about, oh, I've got to update the trustee, especially if it's individual trustees, from that perspective. So that's probably the main one to be aware of, because that does have a hard 6-month rule attached to it. However, in my years of practice, I've never seen the tax office come down hard on that. That's not to say that they won't at some point, but someone has died, and generally, well, not generally, often that can be really challenging for the family, and particularly if there's feuding families, then it can just 6 months. It's not even, it doesn't even touch the sides.
Yeah, and it's important to note that 6 months was really only a bit of a rule of thumb. It certainly wasn't a hard and fast. You must try and stick to the 6 months as close as possible. As you say, Gemma, I mean, when it comes to these death benefits, and sometimes if they're disputed, that can go on for years.
Years and years. Yeah, exactly.
Again, I know I've referred to this. I've been told anecdotally that and I was just told that this is continuing. There's just a feud between a brother and a sister over death benefits, and the way
Mm,
it's going, the legal fees that they're paying, eventually the
more
benefit
than
will actually be whittled away to close
nothing.
enough to nothing. So. It is important to understand that that was only ever a rule of thumb, but by the same token, you can't make it into a PI 55 take and just say,
Yeah,
"Oh well,
I'll just take some extra time.
there's no
Thanks. Yeah,
guidance anymore, so
yeah,
I can just make this. We can just make this go on forever, can't we?" Well, you
yeah.
can't do that, obviously.
And that's the consideration is it wasn't, it was just a, that's their view on what was as soon as practicably for that provision of SIS, which, that's SIS regulation 6.21 or 6.22. And so that was sitting in there. It also used to be in the Tax Act for the exempt current pension income provisions to continue to apply to a non-reversionary pension. There was a requirement that that also be dealt with as soon as practicably. Then that was removed. I think it was in 2021 or something like that. Anyway, so interesting that that got removed. And even to your point, like some of these disputes go on for a long time, including who is this legal personal representative of the deceased. So if you've got feuding families and until probate is granted, then you don't know who that executor or legal personal representative is. So I could have a will that says I'm the executor. So and then you could have a will that says that you're the executor, both done by the same person at differing times. So which one is valid? You might say, oh, well, Jemma, yours might be more recent, but, Bob clearly didn't have capacity to sign that, or you coerced it, or all of these things. And that just adds all this time. So again, the provisions in SIS Act 17A that says you've got 6 months to deal with the trusteeship. So the trusteeship, rather than paying out the benefit, again, that 6 months goes in the blink of an eye. And my experience is that if you are encountering these sorts of scenarios, is to stick your hand up with the tax office and say, look, this is what the go is. Feuding families, we don't have a director or a trustee in place because there's no LPR until they figure out what's going on and which will that might require a deed of family arrangement, which says, okay, we agree that that's the current will, and splitting of the assets in an alternative manner, and then someone steps into that role. So it's really like those time frames. It's all good to have a benchmark and a goal, but it's also you need to understand, I guess, that you can stick your hand up and say, look, we're not going to meet this 6 month time frame. And the absolute one that's in that SISAT provision, but at least the other ones are a bit more generous and practical from that perspective.
Yeah, and as usual, I said that you shouldn't just try and take advantage of the fact that that sort of 6 month guidance has been taken out of any materials that the ATO produces. But as usual, you can't just say that, oh, this is dragging on and I can't do it. You're going to have to need some physical evidence to
Yeah,
sh
totally.
and
Yep.
documentation to show that, well, this actually happened, preventing us from going, progressing the whole process at this point in time. And you'll probably have to continue to do it until obviously the final payment is made.
Yep.
Otherwise, you'll have people knocking on your door asking, "Hey, well, how come this is taking so long?" And something doesn't seem right to us. So always, like anything, you need to document uh,
Document. Yep.
doing and provide an audit trail and more importantly, evidence to say that, well, there's nothing I could actually do. I am doing everything I can to actually resolve the issue, but because of these circumstances, there's nothing I can actually do. Now, Gemma,
And
you
that was
mentioned,
also the consideration in that Gainer case where
yeah.
the tax office said, look, we won't make the fund non-complying, even though it's hasn't ticked off on all these things, but you've got a hard date to get it resolved, which they obviously were aiming for. So that definitely helped.
Now, Gemma, you mentioned previously that it's important to keep up your minimum pension payments, particularly with a death benefit pension, and not necessarily just from an ECPI perspective. Obviously, if you don't maintain that, you will lose the ECPI on that pension.
Yep.
But going back to a previous point that you actually made, if you don't, just say you make some pension payments, but you don't actually satisfy the minimum pension that you're supposed to have for that year, then those payments are then treated as lump sums, aren't they? And then
Yep.
potentially you're in another world of hurt because, as you mentioned, there's a limit on the number of death benefit lump sums you can take.
Yeah, that's right. So if it's not a pension because those payments haven't been made, and there's tax ruling 2013-5 that the tax office recently updated to do with if you don't make your minimum payments, the timing of when a pension ceases and commences and all that sort of stuff. This is not what we're going to talk about today because we've only got a few more minutes of our allotted time to go. But yeah, absolutely. If they aren't pension payments, they're lump sums. And this provision that says it's an interim and then a final, so you've got at most two. I mean, it's not a practical um, rule that's out there. I know there's been a lot of lobbying and advocacy to remove that, you know, first, like interim and final. But then how many is it? So you just don't want someone sitting there just making them all. Again, if that is the situation, I had one where it was 36 lump sums because
Wow.
the surviving spouse, but it was a second marriage. They were trying to do the right thing and kept payments going out to the stepkids from dad's benefit, basically. And so, but that was sort of via her, but it wasn't in pension phase because she had her own situation happening. So it was, a challenging one. Again, a practical approach was taken by the auditor, and there was no breach of those particular standards, which technically there certainly could have been. And yeah, but we do see that as an issue. The other thing with that is it's an interim and a final, but if you pay out a portfolio of shares in one transaction, how many payments is that? Is that just one or is it multiple? And so, if you have a look at some of the rulings that came through back in the day, so this is when we had single one off contributions that by themselves would be excessive of the cap under SIS regulation 7.043. Now I'm showing my age. And they had a look at, like, there were some atoids out there that were about what is a single contribution? Is a portfolio a single contribution? Is 100 shares in a company, is that 100 separate contributions because each share is a contribution, or is it just one parcel of shares? And it was that Goldilocks one in the middle, which was if it's a partial of shares of the same class in the same company on the same date, then that is a single one-off contribution. But either of the other ones, so it's not just every share in a parcel is a single contribution, but a whole portfolio is not a single contribution. So back to my point, if it's a transfer out as a lump sum and it's a portfolio of shares, that's likely to be 10 lump sum payments if we flip it around on its head. Now, that was an atoid from 2008/90. If I've got that right, then I'm going to give myself a pat on the back because there was four all about those provisions. I remember them well. Anyway, so that's another consideration is practically there could be multiple transfers out. So we're never going to be able to satisfy that lump sum. And there's always that lump sum provisions or requirements of the two. And there's always leftovers, always.
I know it's not entirely linked to what you just walked us through there, Gemma, but perhaps um, this whole new or the update to the when a pension commences and ceases could be a good trigger to maybe revisit some of these rules because they are
Mm.
slightly related. And by the sounds of things, some of them need clarification as to how they'll work in the future. And
And
a lot happened
practically, how
back
they
in,
work practically
yeah,
is the other thing.
100%.
Yeah.
What happened back in the day, didn't it, Gemma?
Yeah, it did. Well, that was 2007. So, that was brand new. No, no RBLs, which was magnificent. But then there was limits on contributions. So it just was like pensions, straightforward contributions. Oh, bam, bam. And then there was that whole thing about before you could release excess contributions, there was potential for an excess to be taxed at up to 93 to 95%. So yeah, that was a whole different ball game of sorts back then. So no
So
wonder
getting
I
back to
look so haggard from all these different changes.
no, no, that's not true. So getting back to minimum pensions,
Yes,
it is really a matter of do or do not. There is no
no
try.
try. Yeah, exactly.
In the famous
In typical
word
Yoda fashion.
Yoda.
Yeah,
Yes.
I love
Yes.
Yoda. He's freaking awesome.
Yeah.
So,
Wisdom of the
um,
ages.
yeah.
That
So, I mean, I feel like we've just scratched the surface of some of these death benefit things, and no doubt we'll have. Well, I think our next podcast will go through some other things in a bit more detail when it comes to death benefits. It's absolutely an area of increased work, or um, more and more people want advice in that space because they're getting older. They're considering what the tax implications are. And this overlay of 296 tax have certainly brought a lot of those to the forefront. So it's a matter of being aware. And at least then you can guide and navigate people through how the rules, the provisions work, so they can make an informed decision. And I think that, for me, is always the consideration, for people to make an informed decision about how it works. And sometimes I've sat there and said, okay, well, if you pull this money out, the kids will save 600 grand in death benefits tax. And that is not an insignificant number. But then all
one.
this money is outside super, invested in your own name. You might decide to give some to the kids, but let's say, what it is, an amount is invested outside super. And so if that's generating XYZ a year, the tax on that is what it is, in your own name. So in 15 years, you'll be worse off, or in 5 years, you'll be worse off. So then it's a consideration of, okay, well, what's my longevity? I'm 85. I'm happy to make that call. Oh, I'm 70 or I'm 65. No, I'll, keep it where it is, or maybe do a component of it or manage it all that way. So it's just giving people those options.
Yeah, it doesn't surprise me that more and more people are asking these questions, not only from obviously a tax management situation and how it will best benefit them, but I know without a word of a lie, whenever we see presentations, there is more and more litigation being brought to
Absolutely.
bear in this space, challenging of any sort of inheritance or any sort of death benefits that people might think should have gone their way but didn't.
Mm,
Um, we've been through some of the iconic cases that sort of started this process, but the more we hear about it, the more court cases there are challenging these things. So it doesn't really surprise me that more and more people are wanting to find ways to waterproof what they
yeah.
want to do and what they want their wishes to be once they're no longer with us. So yeah,
Yep.
yeah, obviously a really
That's right.
important thing. And it's good that people are cluing on to that and understanding the urgency of this situation and the importance of, hey, look, we need to get this stuff right, because I don't want any hassles, even though I'm not going to be there anymore. I
Yeah.
don't I don't want any unnecessary hassles for my kids or whoever it is involved, when I'm no longer with you.
Yeah.
And
That's exactly
so
right.
that seems like a pretty good time to wrap this up, Gemma. So,
Yep.
again, thank you very much for joining me from Perth. It was great to see you last week. I'm glad
Yeah.
you
It's
had
good
safe
fun.
travels home and just really enjoyed the session. So, thanks again, Gemma.
Thanks, Darin. Again, like I said, I love having a good chat about this, and forewarned is forearmed, or forearm, anyway, whatever that looks like. Got my metaphors there. But anyway. Yes.
It can just be a matter of don't get beaten by what you know,
Yeah.
basically.
Mm,
Very important.
that's
That's a
right.
football parlance,
Yeah.
of course. But, not bad to weave one of those in as well. But look, thanks again, Gemma. Look, thank you very much to my production team as well, because they put all these things together and load them onto the various platforms that we offer our readership and our subscribers. Um, and don't forget, if you're enjoying our content on YouTube, please remember to smash that like button and subscribe to the channel. Other than that, thank you to you for joining us today. And we look forward to having your company again next time we put together the Cross Country Super Podcast. Until then, travel well and see you later.